Contentious elections around the globe, ongoing deadly wars in Europe and the Middle East, and global economies at a crossroads after the most aggressive pace of central bank tightening in a generation. These are just some of the risks on the minds of the world's biggest investors. But what are the risks that many investors are ignoring? I spoke with three titans of Wall Street: Oaktree co-CEO Armen Panossian, Angel Ubide, who leads global fixed income and macro research at hedge fund giant Citadel, and Walsh, CIO at Guggenheim, to find out what they think are the next big risks. Armen Panossian, co-CEO at asset management giant Oaktree, says investors are enamored with artificial intelligence, but may be ignoring the technology's potential to destabilize job markets. What is the next big risk in your eyes over the next 5 to 10 years?
The biggest risk that I see with respect to the markets and to society in particular is artificial intelligence. Artificial intelligence clearly has the potential for very large economic gains, revenue increases, cost efficiencies, and that investment opportunity is really exciting. It's easy to disregard the societal impacts of those same efficiency gains. What happens to normal jobs that are become obsolete because of artificial intelligence? Think of cashiers or drivers. As artificial intelligence becomes a real alternative to physical labor in some of those areas, millions of people could be out of jobs. So who's going to retrain those people? Because if we don't figure that out, that there will be social unrest, or there could be social unrest because of joblessness. In terms of the markets, artificial intelligence clearly is getting a lot of support from the markets. But just like the internet in the late 90s, there was this promise of revenues growing rapidly. While the gains are clear to see in terms of their potential, the timing of them is impossible enough. And if that timing takes a lot longer than investors expect, I would expect to see pretty violent resetting of valuations and potentially some losses for investors along the way.
What does this look like for an investor who's keeping a close eye on the economy, the job market, let alone investing in AI itself? It seems like the risk you're outlining here could impact many markets.
The attractive part of it and the scary part of it is that there isn't a monopoly on intellect that could be used to develop artificial intelligence technologies. There is a shortage of semiconductors and chips, but artificial intelligence allows economies and countries, and potentially those adverse to the US, to develop certain technologies and skills through artificial intelligence that could be problematic from a geopolitical standpoint. In terms of what investors should be looking at from the economy, I think it really has to do with the number of people entering colleges that are focused on technology degrees versus those that are not. For example, those people entering colleges that are focused on majors that involve moving words on a page, they could potentially be at risk of being out of jobs down the line if artificial intelligence continues to improve in its ability to reference old documents to help support the creation of new ones. It's hard to really have a leading indicator. I think, unfortunately, from the job market perspective, we're going to be looking in the rearview mirror probably after it's too late. So it's really hard to kind of pinpoint what economic indicators we should be looking for.
How do you think about this in terms of how people are behaving right now? Do you think most investors out there are ignoring these risks?
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. I think investors on the private side are spending a lot of time and money helping hyperscalers get up and running, and that involves buying chips, setting up data centers, getting the right power that is needed to run those data centers, getting the right water to cool those data centers. There's a tremendous amount of infrastructure spending happening right now in digital infrastructure investing. And if you're in that groove and you see that there's a tremendous but unknowable in terms of size market opportunity, you're going to just focus on getting capital out the door because it seems insatiable right now in terms of the demand for constructing these types of data centers and other infrastructure. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
What does this mean for you as an investor and how you approach the AI story?
We're careful about who and where we lend into or invest into. We're not sprinkling capital across all players, but we are very selective and we are participating in the growth opportunity offered by AI. With that said, we are careful not to get over our skis and not to get too overexposed or too concentrated into AI, because we do remember what it was like when the fiber optic boom was happening. Now, if there is a dislocation and we do see a re-rating in terms of valuation of assets, we do think that there will be a lot of opportunities to invest in a more distressed or opportunistic way. Oaktree has a very strong business in distressed or opportunistic investing.
What happens in the next 5 to 10 years, or even sooner, if investors keep on ignoring the risks, as you've mentioned?
We will not recognize that there is a bill to pay with respect to employment and with respect to people who rely on paycheck to paycheck jobs, in jobs such as being a cashier, as I mentioned, who will then find themselves untrained and not ready for the new economy. And we will be forced as a society to either have or suffer social unrest or to have a welfare state. The risk is if we don't do anything about it now to retrain some of these people or to prepare for a post-AI employment landscape, we will have issues with a deepening divide between the haves and have-nots, the wealthy and the paycheck-to-paycheck people, and that will mean a considerable amount of harm to a lot of people who don't expect it to be coming their way right.
Angel Ubide, global fixed income and macro research head at hedge fund giant Citadel, worries about an economic future with a weak and fractured Europe.
One of the most important things for the next few years is going to be the strength and the sustainability of the European economy. We are living in a new world that is very different from the last 20 years. And it's not clear to me that Europe is ready for it.
What do you mean by that? And is this a problem just for Europe, or is this a global issue? If Europe is weaker, what does it mean for the rest of the world?
The US, China, and Europe are now competing on a variety of fronts. It's not just economics. It's also national security, it's climate change, it's technology, it's energy independence. The US and China are adopting a set of policies that are leading them to be ahead of Europe. Europe is lagging behind. And my worry is, if Europe is vulnerable, then what happens for the stability of the global economy? What
does it mean for Europe's inability to compete? You mentioned this matters on a national security perspective. You're watching a world that has been rife with war.
Yeah.
What does it mean if Europe is weaker in that world?
What you have, I think, now is a sort of a tripolar world. You have the US, you have China, you have Europe sort of in the middle. The US economy is more close, is more independent, is more autonomous. The Chinese economy sort of the same. Europe is more dependent. And so in terms of trade flows, in terms of alliances, in terms of what to allow and not to allow, Europe is in a more vulnerable position.
What interests do either China or the US have in creating a stronger Europe? Given that Europe is, you're talking about two countries here and a whole subset of countries.
Yeah.
How do you get Europe to unite as one?
So I think what Europe needs to think is to start thinking about its common interests rather than the interests of each of the countries, right? I mean, one problem with the European economy is that it's fragmented at the national level. I'll give you one statistic that I think is really interesting, right? In Europe, there are over 30 telecoms operators. In the US, there are 5 or 4. In China, there are 5 or 4. Essentially means that European firms are smaller. They are catering to their own national constituencies. Another way of saying the same statistic, each European telecoms firm serves around 5 million people. In the US, it's around 100 million people. In China, it's 500 million people. It's just a different world, what you have there.
So if you think about the political forces in Europe, there has been a lot of rise of populist forces in many of the countries that you've named. What interest would there possibly be to create larger national giants
so
at
what they need to think is that to compete in technology, in climate, in energy, in defense, in national security, you need a scale. So European countries need to think, do you want to compete as a small country or do you want to compete as Europe? Now, I don't think they have a choice, because the US and China have already started the race, and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank,
its own large energy companies. Why? Because they want to have national control. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, are going to generate more growth, more jobs, more welfare, but you are going to have less control at the national level.
Is what worries you the direction of travel has been the exact opposite of what you're describing?
There has not been progress in that direction, right? And I think in some sense it's the legacy of the European crisis. It was very scary to see the default in Greece. It was very scary to see the sudden stop of capital inflows in some of these countries. And so there was a bit of a decision to self-insure. How do you self-insure? You have your own bank, your own telecom, your own energy. And I think that's the issue. There is still a little bit of this fear from the last decade that is a little bit blocking the thinking about moving forward.
When you describe a weaker Europe, you're describing a world that is becoming more bipolar.
It's becoming more bipolar between the US and China, yes.
What is the ramification of that?
Well, I think what it means is that it's less global and more bipolar. So I'll give you another example, right? And I used to work at the IMF. The IMF is a global institution. Could we be going in a direction in which countries essentially see an institution like the IMF more of a Western institution? And then China and its pole of influence essentially withdraws from that and decides to run its relationships in a different way. We have seen a little bit of that on the debate on the common framework and some of the issue of sovereign debt in less developed countries. We could be going in that direction if Europe weakens.
It sounds like it would also then be harder to resolve conflict, both security as well as economic.
It gets more difficult because if we don't have a shared sense of what the rules are, as it's been happening, for example, with the WTO, then what is the forum to resolve this conflict?
Well, draw that out a little more. You've named a couple organizations, let's say the IMF, WTO, World Trade Organization. Let's also add NATO into this mix. What does it mean for all of these organizations?
So NATO is another example, but it goes back a little bit to what I was saying about self-insurance, right? The world is better off if there is a common project and there are joint interests. If there isn't a common project and there are no joint interests, then each country says, I'll take care of myself and I will do more self-insurance. Self-insurance is less optimal.
Ann Walsh, CIO at Guggenheim, sees a COVID echo in the U.S. economy with high inflation and an overloaded debt load that will be difficult to unwind.
There are a number of crosscurrents that are happening that we haven't seen before. And I can kind of point to being in a post-COVID world. I almost call this a COVID echo because we're still recovering from all of the changed policies and programs and reactions by policymakers.
How inflationary are some of the policies that were put into place perhaps during COVID that, to your point, we have not seen even play out yet?
This huge amount of spending, we have to now pay the interest cost on that. And there's a crowding out effect with regard to how capital can be deployed. One of the biggest elements I've seen coming out of this sort of post-COVID or COVID echo period is the unevenness of the application of capital. normally what happens in an environment where the Fed is on hold, tightening and later on hold, is that capital gets rationed. And capital goes to then fund only the most deserving of business enterprises and opportunities. In an environment where there's just so much capital flowing and so much liquidity, you continue to see the uneven deployment of capital.
How uneven is capital being deployed right now?
We have a very bifurcated economy right now. We have the large businesses with access to capital. We have the wealth class in America. And then we also have the working class that doesn't have either investment in equities or savings, can't own a house yet because of the cost of capital, and small and mid-sized businesses that don't have the same access to capital, and their cost is substantially higher when they can access capital. So the sort of bifurcated economy that exists, all made worse by the two policies that the Fed has: higher rates and quantitative tightening. And it's going to continue as long as the yield curve remains inverted and the policies of the Fed are not yet to the point of lowering rates.
That bifurcation between the haves and the have-nots, how exactly is that playing out in society? Because this dynamic has been going on for a while now. You're really just starting to see the effects of what it means for the big to get even bigger.
If you want to go all the way back to pre-COVID, at that time, the Fed was even talking about trying to create, remember, they have a dual mandate, right? So stable employment, stable prices. Pre-COVID, they were spending a lot more time concerning themselves with this divergence, if you will, of different earners and the underemployed, and this dichotomy that existed. I haven't heard a thing from the Fed in the last 2 years about this issue and what some call the K-shaped economy. And it'll be interesting to see if their rhetoric returns to concerning themselves with the underemployed or the under-earning part of the economy.
When the Fed raises interest rates, it's a blunt tool. It impacts everybody, but to your point, because of what pocketbooks look like, it impacts people differently. Now that we are years into this fresh monetary experiment, how does it look?
If I were at the Fed, I would be thinking about the tools that we have in the toolkit differently. I would be utilizing quantitative tightening, and to a great extent, they have. Post-COVID, $12 trillion came into the global economy from central banks everywhere. And right now, we've seen about $5 trillion has been hoovered back out. That still leaves $7 trillion sloshing around in the system globally relative to where we were before COVID. Now, adjusting that for, larger GDP and GDP growth globally, probably we need to see about $3 trillion more come out before we get to an equilibrium of where we were before COVID. I don't think the Fed really appreciates the quantitative tightening tool as much as I do, and I think as much as the markets do. Relatively speaking to their adherence to rates as like almost the only tool. It seems to me it's a very blunt instrument.
Is there a way for the Fed to more surgically target the ability to balance the haves and the have-nots?
I do think rates are important here. I believe rates should be coming down. I believe they should have come down faster. They raised rates 75 basis points after SVB failed. That's unprecedented in Fed policy action ever, to actually continue to raise rates after we've had a crisis or a moment, if you want to call it that. And so as a result, they could take that 75 basis points right off and put us back where we were in March of 2023. I think they should do that.
If we take a big step back here, you were talking about the haves and the have-nots and that widening. How much does that mean the government has to step up in the future?
Well, I think the government's already stepped up a lot. I'd like to see us spend a whole lot less. What we have done is we've moved, and by the way, I think the Fed's moved this way too, into a world of industrial policy and using large sums of money to address and advance various political and or policy causes.
If you were worried about the current U.S. debt burden, what trajectory on? Where do we end up 5-10 years from now if we stay on this path? What does the world look like?
Those of us who have been in the investment world for decades, as we have, we look at this and go, this is unsustainable. but so far it has been sustained. And as long as we can remain in some sort of equilibrium where we can afford the cost of debt and we can afford the debt burden, then we're going to stay here. We have the reserve currency, and I think that actually supports that narrative. Having said all that, the cost of the debt at this level of rates of interest is too high. And as it's crowding out even defense spending.
Is what you're saying also that part of the problem is we are still reliant on, as we started this conversation, that post-COVID hangover?
You know, it's Ronald Reagan said, once you have a federal policy, you can't get rid of it, or a federal program. And the truth is that that's sort of where we find ourselves. It's worked so far, so why not keep going? And that's why I say it works until it doesn't. And I think it's going to take, I mentioned gray swans. Gray swans are events that happen that aren't quite black swans, but they seem to happen in more frequency than a black swan. It could take a black swan event. I don't know what a black swan event would look like, but it could take something fairly significant for us to realize that we have depleted our ability to continue to spend endlessly.
I'm Sonali Basak. This is Bloomberg.